You don't have to worry about that. That's if you've got a good credit score. It might be different if it's a little lower credit score, but in general, it's about 1/4% that way. The other thing that sometimes we do is we might do 2 loans. But in that situation, you have to put down at least 10%. I don't have a program that would go up to 95%. So, for example, you might do a first mortgage at, a lot of times I'll do it at 75% of the value, and then I'll do a 15% on like a home equity line of credit. Home equity line of credit is basically like a second lien. They're in the second position. So if something were to happen, you didn't pay your bill, the first mortgage gets paid, then the second mortgage or the second lien gets paid. Generally speaking, those are how they work. Is it's like a big credit card, if you will,
Piggyback loan.
or piggyback loan. They can call piggyback loans. Yeah, very good. Nice terminology.
I'm just trying to.
Yeah, yeah. So the way that they work, a lot of times they're like a big credit card, and they're basically an interest-only loan. And they're the ones that I have right now. They have a base rate of 4.95%. So it's works out pretty good. They're a pretty good factor. Usually that's going to be your cheapest route to go because that's an interest-only portion. Usually I'll give you all 3 alternatives, let you see which way would be best for you. Sometimes people say, you know what, but I'm going to pay down this mortgage in the next couple years to below 80%, and I'm going to take off that PMI. Well, that's fine, and some people will choose the PMI, which is the most expensive, right? The monthly PMI would be the most expensive way to go as far as a monthly payment. And then next is where I pay. That'd be the second expensive. And then the least expensive would be the where you have 2 mortgages. 2 mortgages can be a pain in the butt because then you got to pay a little more closing costs on the second mortgage as well. And again, it's interest only versus the other one includes principal and interest. That's the reason why it's probably a little bit cheaper.
But so once you get your loan to value below 80%, the PMI goes away?
Goes away.
Okay.
Yep.
But that may require an appraisal.
May require an appraisal. Yep. And that's up to, they have a certain time period when they take it off automatically. If it goes before that, you'll have to prove that you have the equity in there.
Right.
Yeah.
The other thing I want to mention is because the rates are so low today, putting more money down doesn't really save you all that much money.
Right.
So if you were to put an extra
True.
$25,000 down, you might save yourself $100 a month. So the question is that $25,000 better in your account and pay $100 more? So that's...
In general terms, if you want to just ballpark something, like how much would this place cost me? You can use $5 per thousand. That's in general. That's about where it would be at today in today's market. So if it's a $100,000 place, you just take 5 times 100. It costs you $500 for the principal and interest portion of the payment. Mm-hmm. Then you take your tax bill, divide it by 12, and then you take your mortgage insurance or your assessments. Thank you. And then the insurance is like $30 per month. So you can quickly, in your mind, just kind of calculate it, or put it on a piece of paper, whatever. You can calculate about where your payment would be on for a particular home.
Any other questions?
Any other questions that you guys have?
I had a question about moving money from account to account. I have like a high yield savings that I've been saving money for down payment portion.
Yep.
Then I have just like my regular Chase paying off credit
Sure.
card, yada yada yada. So I move money one way into the high yield because I'm too lazy to
Makes
finance
sense.
CDs with that, and you get the same amount anyway.
And now you move it electronically, or how do you move that?
Electronically.
Okay, that's easy to track.
So is that something that's hurting me in the long run?
No. It's just that you'll have to prove it.
Okay.
When it comes time for you to get a mortgage,
Yeah.
and we're only going to get 60 days worth of statements.
Okay.
So that's a real easy one.
Okay.
It's when people, get gift money, for whatever their birthday, and they deposit it in there, or they're moving money from offshore accounts, and it's like, wow, you're really making this hard.
I do have my Caribbean gambling account.
And I got a gal, right now, for example, and I warned her about this, 30 days ago, so I hope it won't be quite so bad. But she owns a lot of rental properties, and she gets all these little rent checks in. I mean, she's got a lot of rental properties. She put them all in this account. I'm like, wow, we need to use a different account. She goes, well, no, that's where I need to use this. I'm like, okay. Anything over $500, we have to document where the money came from. So, and that would be real easy. You can see from Chase, you got a Chase statement, you got your high yield savings account statement. Simple. That's real simple.
Okay.
Not hard at all.
And as long as it's been in there for
2 months. I don't
2
really
months,
care.
then you don't care where it came
I don't
from.
really care.
Okay.
Mm-mm. Yeah, I don't need to see any further back than that. Yeah. So now that's why it's really good for you to hear this now. So maybe when you get to
Yeah.
the point where you're getting approved, it'll be really easy for you guys.
Don't touch anything.
What's the process to go from pre-approval to approval?
So the process there is we want to take. So I would pre-approval. I just basically pull your credit. If you're salaried, I don't ask for pay stubs usually, and I usually ask you, hey, did you have any other income anywhere else or anything like that, any other businesses? And then I ask how much money is in your accounts. I'm not going to ask for those statements and stuff up front. I usually don't do that. Now, if they're self-employed, different story. Got some other businesses going on, then I'm pulling in tax records and stuff like that. But normally, I'll pre-approve you based on that. Pull your credit, run it through. Then what we have to do is we have to prove the information that you gave me over the phone in the pre-approval. I'm going to get your pay stubs, your W-2s, your tax records, your bank statements. I'm going to ask you for all these things to match up to what I have in the computer. Okay, and then what happens? Then I do an appraisal. I approve the condo. I do all these things, and then I give it to an underwriter. The underwriter, they say, okay, do I agree with the numbers that Randy's giving me? Yeah, that looks right. That looks right. They basically are saying, okay, I agree with these things. The way that they cash flow the pay stub, the way that they, the balance they took on the bank statement. The bank statement doesn't have all these different deposits that we're worried about. They're going to go over it with a fine-tooth comb. And then they give me an approval. They'll say, okay, this long, and the appraisal came in fine. The condo came in fine. Okay, it's approved, but we do want these couple things. These are a couple things that we want you to get. These are called conditions to the approval. So give me a conditional approval. And then what happens, then I have a team that works with me. Cheryl handles my conditions, and she'll say, hey, Brian, just need you to sign or initial this page, or can you give me information about this $500 deposit and that we didn't get, and then we'll get those, then we'll give that back to the underwriter. Then what they do is they issue a clear to close or a final approval, and then at that point you set up the closing, and then you close your loan.
Okay.
Yep.
Clear to close is the definitive term, because that means everything is
Everything's
set.
done.
But even then, something can happen at the closing, right? Underwriters could take a second look.
No,
at
it's done.
something?
The underwriter's
No.
done that stuff. Unless some funky. Now, the one thing that could go wrong is all of a sudden you tell me about a Chase account and an ING account, and then also we get something from Bank of America at the closing. Like, wait a second, what's this Bank of America? So
Okay.
I need to know where the money's coming from. When you're putting down payments down, and money can't also come from a gift, and I didn't know that it was a gift or anything like that. So we have to know basically where the money's coming. That's where you have one of the problems at closing sometimes. Also, they'll do that. I'm like, wait, or they lost their job. I actually had a client in the last 6 months. They quit their job 3 days before closing.
Actually, quit or lost
They
their
quit
job?
and they started a new job, and they weren't going to get a pay stub for a month and a half.
Jeez.
I'm like, dude, really? Couldn't you just wait like 3 days? Wow. So.
But then they
You're
can't
killing
count
me,
the
Smalls.
income for 6 months, though, right?
No,
they could?
no, we could, because it wasn't a big gap. But the thing is,
Okay.
I needed to have a pay stub to show that they're employed. It's kind of
Yeah.
a funky employer too. And this is after you wouldn't even believe all the other hurdles I had to get it to that point. I'm like, oh, I was about ready. Oh, they ended up. Their mom and dad bankrolled or mortgaged it. They just did it. They
Cash.
gave cash.
Jeez.
I'm like, wow, and
But
It's
this
so
shows
slow.
you how technical
Yeah.
getting a mortgage is
Yeah.
today. There's so many variables.
let me know where your money's coming from. If you're getting a gift, I need to know that, and don't quit your job. And then I think you're okay. I'm clear to close. Yeah.
But also, because we're also looking at potentially FHA condos. So, is there any special things that need?
So
to
if
be
you're doing
known?
FHA condos, the building actually has to be approved.